Welcome to the Ways and Means Committee hearing on the global tax environment in 2016 and implications for international tax reform. Mr. Wiacek, you're recognized.
Good morning, and thank you for inviting me to this important hearing. My name is Ray Wiacek, and I've been a tax lawyer for 40 years, hard to believe, and the head of our global practice for too many years to count. We were requested to testify on the global tax environment, what you face as you consider tax reform. So my written testimony touches on BEPS and state aid and rate disparity and territoriality and a number of other issues. I hope I get a BEPS question, for example, or a state aid question. But I want to talk about competition, and I want to talk about competition fought through the tax code. It's real. It's not the C word. It's not a word that just comes up from tax lobbyists. It's not an empty suit. The UK has a 20% corporate income tax rate already scheduled to go to 18%, and it taxes the return on intellectual property at 15%, already going to 18%. Of course, we have a 35% rate. Now, the UK didn't pass this elaborate rate structure and regime on a lazy Sunday afternoon for fun. They did it to compete. They did it to attract investments. They did it to attract jobs, and they did it through their tax code. And this competition is fierce and political. The UK would have you believe, it would tell its citizens, that there'd be no unemployment. There'd be no cut in education costs. There'd be no cut in rent subsidies if only the American multinationals paid their fair share. BEPS. BEPS has the avowed purpose of increasing the revenue from multinationals, many of which are American. And by the way, it also has as its objective to share that additional revenue more fairly with the rest of the world, that is, not with us. State aid is kind of the little brother to BEPS, where retroactively the guys in Brussels are going after our companies and seeking big back taxes. For example, from Apple, they're seeking $8 to $9 billion in back taxes with respect to a business plan that was submitted to the European governments involved in advance, fully disclosed, and approved in writing. And let me tell you, that $8 or $9 billion, should the EU be successful, will either hurt our American company or, because it's a tax, will be creditable in the United States, and we, the Treasury, our fisc, will bear the burden of the state aid actions. When we lose in this competition, when an American icon is taken over, it has terrible effects on jobs in our communities. People say that, when an American company, an icon, becomes the subsidiary of the foreign company, it doesn't make any difference. It's still a great company. It's still operating in America, the greatest marketplace in the world, so it doesn't make any difference. To me, that's like telling somebody here who was in the majority, maybe in a veto-proof majority, and is now in the minority, that it doesn't make any difference because what the heck, you're still a member. Well, Anheuser-Busch was the king of beers. Now it's one of a number of brands in a beer portfolio run by InBev from Brussels. That's not the same. That's not the same. And St. Louis is going to be hurt by that. I'm from Detroit. We're all rooting for Fiat Chrysler. My goodness, we hope it succeeds. The North Jefferson plant is humming, but Fiat Chrysler's not Chrysler, and Sergio Marchionne's not Lee Iacocca. It makes a difference when we lose these companies. When I first started practicing long ago, I represented Firestone. My firm started in Cleveland 125 years ago, and Firestone was one of the great companies of America. Now, of course, it's Bridgestone Firestone, still a client, still a great company, but it's different. I used to go to Akron. Akron isn't what it used to be, and just by chance, as I was thinking of this example, in the Sunday Times, this Sunday Times, there was a story about the difference between Akron then and now. And the story was about the hundreds and hundreds of dilapidated and abandoned homes in Akron because it is no longer the tire capital of the world. Small businesses are affected too. We talk about them all the time as the generator of jobs. They are the generator of jobs, but they're all part of the big guy's supply chain. Who do you think they make the labels for? Who do you think they make the boxes for? I got an example there too. GE moved to Boston, so we're not talking about a foreign takeover. But do you think the businessmen in Connecticut are happy with that? Do you think the restaurants that are lining up and down the Merritt Parkway to feed the GE employees are happy with that? What if GE had been taken over and moved abroad? So but that's my message. The competition is real.
Give me your best recommendation as to how we get ahead of the pack, how we make the American market competitive. And I'm going to focus, first of all, Mr. Grimberg, on Mr. Wiacek and Ms. Hanlon, because Mr. Wiacek is a practitioner. He's talking to the people in the field. What is it that would put us ahead of the pack and potentially keep us at the head of the pack for competitiveness for the next 20 to 30 years? Because God forbid, we're not going to get to reform for another 30, 25 years down the road. Mr. Wiacek?
If we want to have a real revolution here, the corporate income tax is just a bad way to raise money or to contribute to the fisc. And if we really wanted to unleash American business domestically and internationally, we might consider eliminating the corporate income tax. So we keep looking for ways to get to the middle or get money from the corporate income tax, and the rest of the world's not using a corporate income tax. So we're always going to be disadvantaged, even with a lower rate.
Mr. Wiacek, you talked about the BEPS project. More importantly, what happens when companies move overseas, what the sort of that cascading effect here at home. So what is, in this global environment, what's the threat of job loss locally when we see these companies invert or leave?
You know, I agree with Ed that tax is not the only factor in competition, and that we can be outcompeted because a foreign company invents something we wish we had, or our management is slow, or the foreign company operates under lax environmental regulations or with low labor prices. But I don't understand how anyone can think that tax isn't part of the competition. You compete ultimately with your bottom line, your after-tax cash flow. And if one company is taxed at 35% and another company is taxed at 15%, or if you start with 35 but then plan to get it down, the other guy starts at 15 and also plans to get it down. It's the money that's left over that you can invest in wages and jobs and invest in the future and sponsor ball teams in your local community. If the money you have left over is less, all those things are less.
Mr. Wiacek, can I ask that, because they're really piqued by the point you made in both your written and your oral testimony, that when global companies leave, there is an impact on local communities that maybe you don't think about, from the vendors and the small. Can you talk a little about that?
Sure, because I think one of the reasons I was invited is I am the practitioner. So, you know, I've been to Akron, I've been to what was world headquarters and isn't anymore, and Congressman Levin, I'm from Detroit, you know. I've been to the old site of the Dodge Main plant that is no longer, and we know what happens. I would use Detroit as an example because it's my hometown. Now, there are a lot of factors besides tax, but just look at Detroit. It's devastated, and you know, I'm going to choke up. It's so devastated. So what happens? What happens to all the local vendors? Well, in Michigan, the whole economy was based on the auto industry. At one time, we had all big three. They were 3 of the 5 largest corporations in the world. And Michigan was an unbelievable state. It had more recreation and more tool and die companies and more suppliers than anybody. And those places are all gone. What we forget while we wait about tax reform, people are asking about is the barn door open, is the fire burning. We're not in control of international taxation. Inherent in the definition of international is there at least one other country involved, sometimes many. And they're galloping forward and they're moving on. The different other countries are not going to adopt all of the proposals. Each country is going to adopt the proposals that's best for it. Each country is going to adopt the proposals in its own language. Someone talked about the privacy position. Oh, Ed did, and he said, why shouldn't we give all of our tax returns to every country? Well, Germany already doesn't think it's a good idea either, and has said it's not going to do it. And France has already said, what the heck? So this thing's just going to be, the whole international system is getting rewritten right now in Paris and Brussels. And we better catch up, because we'd like to put a stamp on that.
Mr. Wiacek, you have really touched, you know, me in a personal way. I think I can see your emotion, your passion. Even though we're talking about tax reform, which is not, you know, how can you get excited and passionate about, unless you start talking about what it does to people in America. And the anger that we see in America today is all about what's happening right here in this committee. In the last minute and 30 seconds, I want Mr. Wiacek to continue on with his conversation on how this affects all businesses across America, and what your solutions are. Just list them right off, 1 through 10, whatever you've got, man, I'm ready to write them down.
Thank you, Mr. Chairman. I, too, want to thank the witnesses for their testimony and Mr. Wiacek for your clear passion on this issue. What you demonstrate is that these issues are real to people. They affect real folks and real communities in our constituents across this great land. Mr. Wiacek, I want to touch on I'm going to get wonky here for a second on the BEPS project, the base erosion of profit shifting. This appears to me to be a revenue grab by foreign countries of American companies.
So BEPS was kind of a think tank, do good your effort to fix this, and in a lot of ways it is fixing it. But the view in Europe of what is the right fix is not always in our interest. I think if you have the courage or the will or the way to raise additional money, that would be good. But if the great becomes the enemy of the good, while BEPS proceeds and the rest of the world proceeds without us, and state aid proceeds and our companies are leaving or something, that's a problem, because we can wait around for a long time to get this right. And the fact of the matter is, on international taxation, you folks are not in control. This is multilateral. My main message, this is happening without you. You know, there's been this discussion that there's a vilification of the pharmaceutical and the tech companies for not paying a 35% rate. Thank goodness. You know, the 35% rate is not competitive. And Ed and everybody else, everybody has said we have to lower the rate. I don't think that's the only answer. Then we move on to what do we do about deficits? Do we have consumption tax? What do we do? But just since a lot of them are in your district, there's nothing wrong with the planning they do. Just as there was nothing wrong with getting a ruling from the Netherlands as to their business plans and what the tax effect would be in Europe about it. If we get 16% from them, which was the rate proposed from someone on the Democratic side, that's a competitive rate. That's where they should be. If you actually expect everybody, and you're really mad at them if they don't pay the 35% rate, if they pay the 35% rate, they're toast.